Good morning. You're watching The Market right here on ET Now with me, Aisha Faridi. I've got McGuire as well joining in. I don't think today is about equity markets. Today is just about what's happened in the crude market, Abha. The fact that WTI tick went sub the $2 per barrel as well overnight after a huge intraday slip-off. And I think that's the headline maker this morning.
Absolutely. So let's actually run you through what happened and why this has had the impact that it has on the price. Concerns, of course, that the world is running out of places to store crude. We know that already, and this essentially means that all those tankers that are full to brimming with crude right now have really no takers in the current demand environment. The current May futures contract, which expires today, has dropped to minus 37.63 a barrel, which means that oil delivery for next month has essentially been deemed worthless. So that's really what's happened on the futures contract, which led to that price, hitting that literally nil mark. What does that mean, however, for going forward for the next month? It does mean that prices are likely to be back up around that $20 mark for that contract. So, Aisha, of course, in the near term, there's a lot more to discuss here with regards to just perhaps bringing to light once again how extreme the situation really is in the crude market.
Oh, absolutely. The fact that oil futures have been contracting, the expiry since Tuesday went negative in this bizarre move showing the demand collapse, and now finally settling at 162. That's where we're currently at for NYMEX and Brent at 25.74. Let's in fact take this conversation forward. Joining us right now, Jonathan Barratt as well as Peter McGuire, both on the show right now. Gentlemen, morning. Jonathan, if I could start off the discussion with you. What's happening here? I mean, I don't think historically we've seen these kind of levels in the recent past.
Look, you're dead right. I think historically I've never seen the situation actually occur. But also we have to note that when you do get an expired contract, that if you are long, particularly on the NYMEX contract, that it goes to physical delivery. So if you're an investor and you actually hold crude, then you can't actually have a place to put these barrels. Then you have to sell the contract. And I think the fact that we've had a lot of issues concerning the supply or demand destruction that are occurring, that those people that have long futures contracts have had to exit it, regardless of what price they didn't make that delivery. So this has exaggerated the situation. This is why we've seen prices go to the negative. When you look at the forward contracts going forward, June, $21, $21.64 on the NYMEX, that suggests a little bit of normality will come back to the market eventually.
Peter, wanted to understand from you as well. I mean, the fact that we are seeing this freak trade come out in crude is one thing. What's going to help us pull back out of this situation? I mean, when is it that we're going to see levels getting back to at least normalcy?
Gee, that's a hard question. And following on from Jonathan's point, I'm not sure how long it takes to actually get to some form of normality. These are unprecedented times. They're unprecedented market moves. This could take 2 quarters, could take 3 quarters until things start to ratchet back up to, the $25 to $30 plus range. It's too hard. There wouldn't be an analyst anywhere on the planet that'd be able to give you a decisive number where it's going to. It's pure speculation. The uncertainties, it's uncharted territory. It's nearly to the point, it's very similar to what we experienced. I was in New York in the week of where it hit $148 a barrel. That's NYMEX. So that gives our viewers some sort of indication. That was, I think, about the 2nd or 3rd of July 2008. And it's extraordinary times. And this is what happens in these markets. And futures are just an instrument that demonstrates that. As Jonathan said, you've got nowhere to store the damn stuff. So what happens, you've got to take delivery, and that really creates a nightmare position for any particular holder of a futures contract that's on the wrong side. So there you go. I think it's going to take many months until we get some sort of headline moving forward as far as consumption patterns growing again.
Okay, give us a sense of how the dynamics of the oil market may have changed, Jonathan, for all the the slugfest that we saw between Russia, between the Middle East. Have the dynamics on ground, the physical dynamics in terms of market share actually changed? Has there been any significant shift?
To stabilise
Jonathan?
OPEC. So can you hear me? Hello?
Yes, go ahead, go ahead.
Yeah, that's okay. You've got people there that you've got OPEC plus wanting to stabilise the market. Also, you've got the oil shale producers wanting to stabilise the market. I love this word stabilise. It means trying to make more money for those people producing it rather than looking for those economies that can benefit. And when you look at India, this is such a big injection to such an important economy when the price of the imports are a lot lower. So this really should be benefiting India very well, in terms of that import. The other important thing to note is that how do we climb out of this situation? How do we get prices to normalise, I guess, in terms of a sense of, production, supply, demand, where the price stabilises. And I think this comes to how we actually come out of this crisis. And what we're starting to develop is that we might get a V-shaped recovery in confidence, but a U-shaped recovery in demand. And what that basically means is that the forward price contracts for a lot of these commodities will actually start to increase. The forward-dated contracts will increase in value more than the spot one, which is a normal contango market, but it'll be more extreme whilst the economies start to recover. And I think those economies which will start to recover are those ones which are more reliant on some of these imports like India. So it will be quite interesting to see how it unfolds, but at the end of the day, we need that confidence to come back into the market to then have people have confidence to then go out and purchase.
Absolutely. Peter, when talking about impact on India, we're not necessarily seeing that play out just as yet. The most obvious one, of course, would be for it to benefit the government's balance sheet. But we're not yet seeing that instant reaction, whether it be on prices, that the retailers are setting or otherwise. How do you imagine this playing out, particularly in terms of implications for India?
Well, I'm sure that it'll be felt or it'll be demonstrated in price over the coming weeks. And that's it'll go to the end consumer. So there will be a saving there, naturally, more dollars in their purse and pocket and wallet from just the sheer price decline. I think that's going to be an evident flow on. Now, where it moves from here, I don't really necessarily... Depends on how quickly the likes of, your big cities and the nation starts to become, work itself out of that lockdown scenario. Is it going to be many months or is it only going to be a month or two? That's the unknown, and this is where it creates the angst to any form of importer. We're not sure as far... And, the consumer's the end beneficiary in a lot of ways to this. So, the mindset is very much of an unknown. And as Jonathan said, the contango, you could see very, very large price discrepancies over the next matter of months also from a trading perspective. So, this is, many traders, and this is where, and I'm more on the retail side, the speculators, they're very, very conscious of this and they're looking at these particular markets as a very attractive mindset to trade on the different instruments. So all I'll say is this, that, with the big volatility swings, it's not a bad part of the market to, embrace and be a part of at the moment.
Gentlemen, we'll leave it at that. Thanks so much for walking us through what your thoughts on crude are. Just looking at the Asian screen, it's not the best of mood that we're stepping in for trade in. You've got Japan lower by about 1.25%, and across the board, actually 1 to 2 odd percent kind of cuts is what you're seeing. Wasn't the best of closing for even the US equity markets, where you had the Dow fall about 2.5% and the S&P as well lower by about 2 odd percent or so. The SGX Nifty indicating a weak start for us. We're going to take a very quick break on that note. When we come back, our chartists and fundamental experts join in to dissect and analyze how trade is likely to be this Tuesday morning.